How's it going, everyone? It's Sam. I want to talk to you today, giving you kind of a SPAC 101 course. So, I talk about SPACs a lot, especially over the last month or so. These are special purpose acquisition companies or blank check companies. And this is something that is new to a lot of investors. A lot of people haven't really heard about this. They know about the stock market, but they might not know about this type of acquisition. And I'm going to talk to you today about some burning questions that people have had. So everything from what is a SPAC to when would you buy or sell a SPAC? Why is there limited downside but unlimited upside to a SPAC? Why it seems like so many SPACs are getting sued, and just talk to you today about why I think SPACs can offer great value for investors. So if you guys like this, please stay through to the end. I think all of this is really important. Even if you know what a SPAC is, this might help you put it in terms that you might not have really thought of before. Also, if you guys don't mind just smashing the like button down below, I really appreciate that. You can just tap it right down there. Also, we are almost at 50,000 subscribers. It would be awesome if we got there today. More than half of the people that watch these videos still aren't subscribed. So if you don't mind hitting subscribe, I really appreciate that. And if you want 4 free stocks through WeBull, they did extend this through the end of the month, so you should definitely get those 4 free stocks. Definitely check out the link down below. Just deposit $100. And if you guys want to start investing with M1 Finance, there's a link down there too. I really like them too. WeBull and M1 are my two main brokerages. And last thing, if you guys want to know exactly what I'm buying and what I'm selling, I bought a couple more stocks yesterday. So I bought shares of 2 different companies. I talked about them both on the channel yesterday too, but you can definitely check out the link down below to Patreon and join that group. So we're talking about SPACs. These are special purpose acquisition companies. This is kind of the year of SPACs. A lot of people have been investing in them, and a lot of people have done really well. Think about companies like SBE, think about DraftKings, think about Virgin Galactic, all these companies that were taken public. And this is a way of kind of doing a backdoor IPO. So an IPO is an initial public offering. This is when private companies go public. Now, SPACs are different for the fact that these companies, these SPAC companies, are formed with the sole intent to buy part of a private company. So an IPO, the company actually goes public themselves. These companies buy part of another company and then share the profit. So usually these are by totally different people. They'll make this management team, they'll raise money, usually just from the fact that they have a good management team or that they're looking to get into some different sector, and they'll often start their shares at $10 a share. They'll put out so many shares. Usually SPACs generally, again, this is an overgeneralization, will be anywhere between 250 million to 600 million or something like that they'll raise. And of course this changes, but generally that's kind of the idea that they're looking for. Some are much higher than that, like PSTH raised $4.5 billion. But again, they'll buy maybe anywhere from 4% to 25 or 30% of some company. And this brings up the first thing that I want to talk about, which is that a lot of people don't understand how to value SPACs for several different reasons. So let's take a look at ChargePoint, for example. This company started at $10 per share, and they gave out this investor deck, investor presentation. They had an enterprise value of $2.4 billion. Now, they are buying part of the company, and that part of the company was valuing ChargePoint at $2.4 billion. However, now the stock has gone from $10 a share up to $35. So that has drastically changed the value of this company, the enterprise value. So you have to take that into account. So enterprise value is just the value of the company based on the number of shares and the cost of the shares. So let's take a look, and this might be slightly off, but this is generally how you think about it. So this company has gone from $10 up to $35, so it's gone up 3.55 from the original price. Now you can multiply this by the 2.4 billion, and this company is valued around $8.5 billion. Now, again, this could be off a little bit, but I think so many people, even YouTubers, I see YouTubers that have hundreds of thousands of subscribers, they're still valuing SPACs after they go up at the same amount that they have on their investor presentation. That's not correct. I mean, think about it this way. If you bought 10% of a company, you spent $10,000 to buy 10% of the company, you would value the company at 100,000. But let's say someone else came up to you and said, I'll pay you $20,000 for that 10% today. The company is no longer valued at $100,000. You have someone that's willing to pay you a value of about $200,000 for the entire company, but you only own 10%. So now it's valued at double that. That's something you have to consider. That throws off every single metric that is in here if you compare it to like a price to sales ratio, a price to earnings ratio. So that's something that you need to know right up front that so many people don't understand. I've had a lot of other YouTubers ask me about it, and this is how I've learned it through several months of investing heavily into SPACs and doing a lot of research. So the question is, why would a company go public through a SPAC as opposed to an IPO? Now, the reason that companies like this as opposed to an IPO is it's much simpler, and right now there are less regulations behind it. So the SEC has said that they're going to crack down on these next year or the year after, but right now it's much easier for companies to go about the SPAC route and go public that way than it is through an IPO. There's less regulation, and they only have to make one company believe in them. So instead of going out there and doing all these talk shows and trying to sell themselves to all these retail and other types of investors, they can just sell themselves to the one company, and then if they buy part of their company, then they're all good. So it's a way of going about the IPO process much faster than a traditional IPO and a lot less work. So that is what the SPAC is. Now, they usually start off at $10. Recently, though, there's been a lot of hype behind them, and that's for a couple reasons. So first of all, there's been a lot of EV SPACs and SPACs that are in spaces that are growing, and people realize that there's limited downside. So again, I'll tell you when I like to buy and sell SPACs towards the end, but there's limited downside for a couple different reasons, and I'll show you on the screen here. Most SPACs will IPO around $10 and carry a cash value around $10 to $10.20. Now, this has gone up a little bit since this was written, but that's an important point because it essentially equals your downside until merger approval. SPAC holders can opt to redeem shares at the redemption cash value either at set periods or upon certain votes, a merger being one of them. If you don't like the deal, then you can sell on the open market or back to the SPAC. So you can actually claim your $10 per share or whatever it starts at. I believe PSTH started at $20 a share, but they start at different values. Most of them, though, probably 90% start at $10 a share. And you can actually claim that $10 if you want to before the SPAC merges. So after the merger takes place, and they put these dates out in front of you so you know with a little bit of time, before it merges, you can claim those $10, but after it merges, it's like any other stock. It can go up, it can go down, it could hit zero. But again, if you don't like the company, you can redeem for $10 a share. Usually you just have to call up your brokerage. I have not done that, but you can probably Google it if you want to figure out more about that. But what this offers is a limited downside. So for example, take a look at a stock that we bought yesterday. This is THBR. Now, I bought at $10.75. This is a semiconductor company. It's in autonomous driving. It's in car connectivity. I'll put the video up on the end screen, but we're down a couple percent. We've lost 3 cents per share. Not a big deal, but the max amount that we can go down to essentially is $10 per share. Now, of course, this is not financial advice. Do all your own research. I'm not a financial advisor, but it can only go down to $10 a share. So that means that we have a limited downside, about 7 or 8%. So I invested in this company. I realize it's risky, but it is in a sector that's buzzing. And I realize this is speculative, but I planned on selling out before the merger date. So again, I can lose 7, 8%, but just based on all the SPACs that have been happening recently, this is most likely going to go up to $13, $14, $15 a share. Now, this is less the case than it was even a month ago. SPACs were blowing up left and right. Every single SPAC, it seemed like, went up to $20 or $30 a share. That's not quite happening right now. A lot of them are going up to $13, $14, $15 a share. But I still think this offers a lot of upside. This was just announced yesterday that they were going to merge, and then it dropped off a little bit. So you can see here, and then it dropped off about 7%. Again, I can only lose 7 or 8%, but I can gain hundreds of percent, even in the short time that I bought this. So I plan on holding this for the short term. That brings up the next question, which is, when do I look to sell SPACs? Do I try to sell before the merger date so that I have limited downside? Do I try to hold longer? Well, this gets a little bit more fuzzy. This is where it's important to know about investing and what to look for in a company. So I'll give you a couple examples. There are 3 different companies I'll show you here. The first one is MP Materials. So I talked about this a few weeks ago. This is a company that mines for rare earth materials. Now, if you don't know what that is, it would mean nothing to you. It would be kind of confusing why it went from $10 a share all the way up to $27 just in a couple months. But rare earth materials supply a lot of our technology. A lot of technology requires this, anything from cell phones and computers to electric vehicle batteries. So this is a company that runs one of the biggest mines in the world for rare earth materials, and China controls 80% of the market. This company controls 15%. So worldwide, this company controls 15 of the remaining 20% of the rare earth material market outside of China. So that's where it doesn't all break down to numbers, right? This company does not produce enough value right now to justify its $4.2 billion market cap. But when you break it down a little bit further, when you think abstract a little bit more, you realize that the US does not want to rely on China for the ability to make our technology, right? We don't want to have to rely on them to be able to scale our technology and to be able to innovate, because China is one of our biggest competitors in technology in the world. So the US government does not want to let this company die. It doesn't want to be pushed back. Even if this company were to go under, that would send them back several months at least, probably more like years. And that could be a big difference between our ability to continue to innovate and make better technology. So this company has an X factor. This is a company that was a SPAC. It's already merged, and I plan on holding this. I do not plan on selling it. I bought it after the SPAC merger date, and it's done well for me so far. The next company is SBE. This is merging with ChargePoint, and this one is back and forth. It's very volatile right now. You can see it went all the way up, I believe, to $44 a share at one point, and then it's down about 16% since then. And I'm not even worried. I hope it falls down more. I hope it falls to $1 a share or $5 a share. I'd love to pick up more of this company. I don't think that will happen. I think maybe it will fall down to 30-ish, but maybe not even then. This company owns 70% plus of the EV charging market in North America. They have such a market dominance compared to everyone else that I like this company for the long term. I'm not selling it. I'm not trying to time it out or anything like that. If anything, I'll add when it drops. I'll be excited if it drops, because this is a growing market as we have more and more electric vehicles. This is a company that can take advantage, and you don't have to worry about them trying to innovate all the time. I mean, with cars, just think about it. With car manufacturers, they always have to have one of the best versions of the car available, right? They always have to innovate. They always have to be on the cutting edge. They always have to keep on putting in the time and putting in the effort and getting the best vehicle out there. With charging stations, it's generally just if they have the best product and if they have the best team to be able to sell it. And after they've created this network, it's pretty much done, because obviously they'll continue to grow and continue to grow. But if you Google them, they have so many different stations available. There's obviously a reason that they already have a lot of market share. And after they set up those stations, they get residuals, right? They don't always have to continue to be the best product forever. They just need to continue to be a solid product, and people will find them and want to work with them. So they've already worked with a lot of Fortune 500 companies. I think that they will continue to dominate the market because they have such a large market share already. So I plan on holding them for a long, long, long time. I think that they'll be a really good company. The next company is THBR, and this is the one that I was just talking about. I plan on selling this before the merger date. I don't understand the company well enough and understand where they get all their numbers, because some of it is a little out there. They have really high expectations, but if you look at this year's revenue compared to last year's revenue, it's the exact same. So they have said that they expect $23 million in revenue, but then they expect $85 million or something like that, maybe 70 something million next year. And they give no reasoning behind that. Of course, they'll probably say the pandemic, but I would have liked to see that and have them explain that. And then they also give some projections for how expensive materials will be in cars in the future and how much they'll be able to sell. But I don't honestly understand the semiconductor market that much in cars. This is a speculative play, but it offers limited downside. So that's why I invest in this company. And I consider it investing, but you might say it's a gambling, which might be true, but there's a very limited downside to this company. So we talked about when to sell SPACs, and of course, do your own research. I'm not telling you when to buy or sell. I'm just telling you what I think. We talked about whether you should hold through the merger. I think it depends on whether you're a long-term investor in the company, if they have some kind of X factor that makes them different than everything else, or if it's a high barrier of entry market, or whether it's a company that you don't really fully understand. It's really hard to keep up with a lot of different companies that you don't understand. It's not good for you going forward because you can't see all the warning signs and be able to see when you should invest more. And we talked about why SPACs can offer great value and limited downside. The last thing that we need to talk about is why all SPACs are getting sued. So I want to be clear on this. Not every SPAC is getting sued, but I have people write this on every single video that I create that's on a new SPAC that was just announced. They always Google the SPAC or the company, and they see this. Shareholder notice. Brodsky and Smith LLC announces an investigation of Thunder Bridge Acquisition 2 Limited. So this is the company that we are just talking about. They almost always see this and they get really worried. The thing is though, this is not showing that they're getting sued. And of course, any of these companies could get sued. I could be wrong when you see this, but 99.99% of the time, this does not mean that they've done anything wrong. These are essentially ambulance chasing lawyers. So what I mean by that is every time there's a SPAC, they put this out there, and think about it. This makes a lot of sense. If there's any ill doings or if there's anything sketchy about the company, they can make, I don't know, tens of millions, probably millions, tens of millions, hundreds of millions from suing one of these companies if there's anything that they've done that isn't up to code. But it costs them barely anything to put this out there. They probably have some secretary write this up. It's probably copy and paste. They just change a couple names and then they're done. They're just fishing for info and it costs them pretty much nothing. So if they have 1 out of 10,000 cases that actually pan out to be something, that's great for them. Now, if you want to look, this is just that law firm. I went to their website and this is all the different companies that they have cases for. You can see here that they have a ton of different corporations. And some of them are actually pretty big. I'll show you here in a second. There are some ones that you would definitely know the name of. Shutterfly, Caesars Entertainment. There's Under Armour on here too. There are a lot of different companies. And like I said, they're just ambulance chasing essentially. But, I think that worries a lot of new investors and makes them wonder if they should invest in the company. A lot of them get pushed back a few days, and then instead of $10.75 like I bought my company for yesterday, they buy at $12 or $13, which presents a lot more downside. So you can definitely take this and use it to your advantage in the future. Let me know if you have questions down below. If you guys want to be able to ask more questions or if you want to talk to other investors, you can join the Patreon. There we're talking about SPACs every day and good opportunities to invest. Definitely check that out and you'll get every single stock that I buy and sell if you check that out. Also, if you guys want those 4 free stocks through WeBull, you can definitely check out that below too. Just deposit $100. Thank you for hitting the like button. Thank you for hitting subscribe. If you want to see either of the videos on the stocks I bought yesterday, I'll put them both here. Thanks.